Welcome. You see gap trades every single day. So how can we take advantage of them? How can you refine your trading strategies? Because when you're looking for things that are active in the market, probably the first thing most people do is what is gapping up, what is gapping down. It's the go-to just in terms of if I know nothing, if I don't know a single news story that's happening in the market, if I have no idea what stock I want to trade, or anybody for that matter, then you go and look at any kind of a scanner and show me a bunch of things which are detached from their price levels the day before, and it's the easiest hint that something is going on. But one of the biggest problems about a big gap to the upside or the downside, and you've probably heard this before, is some of the time those gaps like to get filled. And you can get into a lot of trouble when you're playing gap trades if you're married to the notion that if something gaps up, it's a long, something gaps down, it's a short. It's never quite that simple, trust me. That's just not how the market's gonna give it to you. So I wanna make sure that we have a good idea of how to approach these, because it's gonna be in your toolbox for any kind of a momentum trader, and you're not gonna ignore stocks that have gapped up or gapped down. First things first, I like to define what is an actual gap move, and if something just happens to be higher or lower than the day before, it might not be considered a quote-unquote gapper. So I'm going to use an extreme example to make an obvious point, starting with something like Amara here. So over the weekend, basically everything crypto was gapping to the upside. And when you close down at 1840, and you're going to end up in the pre-market up at 1960, that's a good 5%-ish type move and change. That's clearly going to hit a lot of scanners and be interesting. But what makes this, in my opinion, a good gap to look at in the first place is it's not just that it's higher. Imagine this had gapped up and it was at 1910 or so. Yes, that's a gap up, but it's not even higher than a resistance that was just there the previous trading day. In this particular case, it's gapping past that resistance level, and that puts it onto your radar. But remember, take a step back, fundamentally, what does that gap mean? There's not a lot of volume in the aftermarket. It's not zero, and it's not zero in the pre-market either. But when you have a print go off, let's say at 19.5 at 6 a.m. in the morning, and let's say someone buys 100 shares, that's obviously going to pale in comparison to the thousands of shares that are going on when the live market is open. So you might have trades going off at those new prices, but it's a small amount of volume. And all of the big institutional order flow and big heavy trade volume is going to come after that open. There's something to remember in the overall market. The vast majority of gains, and this is just true, it's true in the Qs, it's true in the SPY, the majority of gains over time actually happen in the aftermarket. And gaps tend to be a big part of movement over sometimes what you see during the day. So you want to ensure that when the gap happens, when the market opens up, there's still strength in that stock to support those new levels. And like I said, and use an example that's extreme to make a point, and that would be MAR. It's not rocket science. You see the gap to the upside, it would be easy to say, okay, well, it closed at 1840, it's got support. Who cares about that? It gapped above a resistance level at 1925, and then it's consolidating above that price. Before I think this is a continuation play, I want to see strength off of that level. And this is an area where you just didn't see it at all, so it's easy to say it tried to hold above. Right at the open, it fell underneath, and I would favor the short at that particular point. But I do want to show you an example where you might find one that is a bit of a long. So here's a different gap. In Coinbase, which is in the same space, it gaps up, you go to a previous resistance level, and then at the open, now I was looking for longs, did not get the early long, it happens. But in this particular case, this gap fill, attempted gap fill, tries to break through the previous resistance, it's clearly a big up gap, and then it holds. That's an example of a good continuation setup, because when the market opened up and it attempted to fill in the gap and people were taking their profits overnight, there was enough buying strength in this particular case to have it then go higher. So it tried to break the lows, so there was definitely some selling at the open, immediately jumped, and then immediately made a higher low. So there's your sign of strength. Now, whether or not you're just one of those, I'm sitting on the bid out in front of 50, or you're trying to catch a stair step up, maybe you grab that kind of a long. But what it did for me is it signals strength. Because when it then retested the low, and if you don't have that trade there, when it retested the 250 level, which I had as another key price level, it was worth it for me to try a long bounce because I felt this had strength despite the fact that it already made a decent top. So you have two names which were both running and gapping up related to crypto, one of which immediately found no buyers at the open and relative weakness, so stay away if not look short, and the other one showed you pretty clearly here at the open that you had a bit of a gap and then a hold and a continuation play. It's a simple thing, but when you're looking every single morning at 10 gappers and small caps here and there and a couple of big caps, and maybe you're going to have some chip names in there as well, continuously gapping up and down, you do want to ensure that just because something is a big percentage move doesn't automatically mean it's going to be stronger. You want to see those types of indicators that there's buyers above that previous resistance. There's buyers at the open that aren't going to try to fill in that crazy gap to the upside. It's so easy to catch yourself off guard. And we've all been there. Obviously, it's one of these things where if you've been trading, you trade gappers every single day. I'm going to give you another example, but this one I'm leaving for last on Tesla because of why this is an even better play. Now, it might not have ripped $10. I'll grant you that. Like Tesla, even from 71 where it came in, I think the high was like 74. So it's only about 2%. We've seen Tesla do much more than that. But when this gapped up, and clearly it gapped to previous resistance level, it then tried to fill in, actually went halfway. And this is the pre-market. There were sellers in the pre-market. It got right back up, put in a resistance for previous resistance, and then sellers came back in to hold the same level. What's great about this is the multitude of setups that this one provided you. So throw out the fact that it already had a wipeout bottom the trading day before. You have a clear and obvious 171 level that you can see is key. It was key the day before, it was key the day before that, it was resistance in the pre-market. But then on top of that, you then get the added information of sellers in the pre-market pulling it down into 68, which held. And then right at the open, they try to sell through 68 to fill in this gap underneath, and then it holds the 68. So at that point, you have one opportunity for a long off 68. If you don't get that, then the 171 level's in play, and you see it sort of stair step to the upside. And again, it just comes down to splitting these things into relative strength and relative weakness. A gap up, what is the response? It was clean in Coinbase that it just gapped up, held, and went higher. It was clean in the example I gave with Mar that it gapped up, immediately came down, started to fill in the gap, and was weaker. Tesla is in the middle here. It gaps up, pulls back to a middle, then holds the middle by the open, and then gives you the trend trade. So you've got to be flexible in terms of your thinking. You always want to drop things into categories if you can in different subsets of trades. The gap trade is no different. If you just treat every single gap up or down in the same lens, you're going to miss those nuances that are out there available for you so that you can avoid some trades that aren't going to work and so that you can focus on the ones that set up almost perfectly for your strategy. And it all comes with being specific. So not every gapper is alike. No two gappers are going to be alike. Make sure you follow these kinds of plans so that when you evaluate what you want to trade on those big gappers, you can identify the best trades. That's your lesson of the day. Trade your gappers, but make sure you're in the right one.
Thank you very much, Neil.